Thanks, Anuj, for that. Well, the big cue had to be coming in from the US overnight and the Fed meet, where, in fact, the Dow rallied over 400 points after the Fed statement. Lata alluded to the fact that how many times they mentioned the word patient. So the Fed committee did say that they will be patient as it determines what the future adjustments to the target range for the Fed funds might be in terms of going forward. So that was the big statement which came in from the Fed. And we had the Dow, S&P, NASDAQ gain. We had the dollar index, which in fact softened after the Fed statement. Plus, we had the yields which softened a little bit, so around 2.69 currently for the 10-year US Treasury. And in terms of the other cues, it was definitely what happened with oil prices. So the WTI contract in terms of crude prices is now at a 2-month high. We had US inventories which rose less than estimates. And there are sanctions on Venezuela which are really worrying the market. So we have Brent crude which has now risen above $62 per barrel. Back in Asia, we had the Chinese manufacturing data for the month of Jan, which in fact was still in contraction mode for 49.5 versus 49.4 on a month-on-month basis. But nonetheless, it was a little better than what the street was estimating. So the street is probably taking heart from that. Asia in the green and SGX indicating a positive start as well.
All right, Ita, thanks a lot for that. In fact, that was the big cue, right? The US markets rallying overnight. The Dow, in fact, getting back to that 25,000 mark, and solid corporate earnings and an accommodated Fed Reserve. The Fed Reserve kept interest rates unchanged and said it will be patient with raising rates moving forward. Paul Kitney, the chief equity strategist of Daiwa Capital Markets, joins us on the phone line. Paul, hi, good morning. It seems to be good tidings for the global markets, especially developed markets like the US. What's your own prognosis on how things may shape up, at least in the first half of the year?
Good morning. Thanks for having me. Actually, my take is that this is actually really good news for emerging markets rather than developed markets. Yes, it's good for equities as an asset class that we're seeing a less steep path of normalization on the part of the Fed, in my opinion, actually, where the Fed has either peaked its tightening for the cycle, or there's only one more hike for this year. So certainly what we've seen there is an indication, number one, is that the Fed is keeping an open mind on the economic cycle, which is toning down in the U.S. So they're remaining flexible as opposed to their sort of previous guidance of a steeper path of normalization. And second of all is that there's no guarantee that the next move will be to actually taper further on the quantitative side. So that could also come to an end. The bottom line is that a less steep path of normalization on the part of the Fed is actually negative for the US dollar, which is actually positive for emerging markets. The emerging markets, many of them have dollar-denominated debt, so their debt servicing burdens improve with a weaker US dollar. So this also takes pressure off central banks, particularly in those countries, that hitherto, in the past, 12 months in ASEAN and also to some degree in India, may have been facing inflation-related issues. A stronger local currency in emerging markets takes the pressure off central banks.
So, Paul, good morning. What would be your pecking order, since you say EMs as a basket will be the preferred place?
Yeah, so in the context of the Asia Pacific, we have recently actually changed modified our strategy slightly, where we've downgraded developed markets. So we're underweight Japan, we're overweight Asia ex-Japan in APAC, and within that, our biggest overweight is India. And we've been overweight India for some time now. So versus the benchmark at around 10.3, we're 14% in India. ASEAN we've upgraded as well to 17.3 to 13.9, and in particular Indonesia and also Thailand. So given that inflation is dropping, now inflation expectations have dropped from 2.2% in June of last year in the US to 1.8, below the Fed's target 2% inflation rate, is the primary reason the Fed is cooling things off in terms of its tight monetary policy. So this is a global factor, where those countries that previously suffered from inflation that was affecting both their monetary policy and the pricing of equities, they're getting the most relief. Now, in Asia-Pacific, that's India and also ASEAN are the major beneficiaries.
Okay, and so also India has a budget coming up tomorrow. Is that a worry at all? I mean, there are competing offers by political parties of large, distress packages for farmers.
Yes. So this is a short-term supply issue on the fiscal side, which is why we've not seen a big move in the bond markets there very near term. But essentially, if we're going to see a stronger rupee on the back of a weaker US dollar, lower oil prices versus 6 months ago, significantly lower, improving the current account balance, then this is going to put the downward pressure on the inflationary macro environment in India, which should drive down bond yields and beyond the very near term, offset those near term fiscal supply issues.